Hey guys, welcome back. Today's video topic may seem to be a bit of a departure from what we've been doing on this channel for the most part, but I think it's well suited. Generally, I like to think of the topic of this channel as using logic and rational thought to understand the world better and to make your life better. And this falls squarely within that realm. In fact, it may be one of the most profitable videos for your life that you may ever watch. And I mean that obviously in the literal sense of financial profit, but I also mean in the sense that having more money just allows you to live a better life overall. So hopefully these videos and this topic will help you along those lines. So the motivation for this specific video comes from a really good question I was asked by a friend recently. He said, Todd, why do you think it is that most people lose money investing when the markets go up? And I think this really does get to the heart of a lot of great questions about human psychology, logic, investing, markets, those kind of things. So let's get into it. First off, though, I want to establish that it is, in fact, incredibly easy to make money investing. In fact, if you wanted to invest and be virtually certain of making money, you could do so. Here's a few ways how. If you want to be insanely safe, here's what you do. You put your entire portfolio in basically government bonds, and the only way those default is if the entire government fails. You want to be even safer than that? Put the money in government bonds of various governments, so you need multiple governments to fail for you to lose all of your investments. Essentially, this is about as safe as you could get, because if the government's going to fail anyway and you had your money in cash, that would have lost money in any case. And so you're essentially just getting paid a premium for the use of your money and taking a very, very minimal amount of risk. It's virtually a guaranteed return. You're basically going to make money no matter what. Now, the problem with this strategy, obviously, is that the returns are very small. You're not taking a lot of risk, and so you're not being paid a lot for the risk you're taking. You could make this strategy a little bit better in terms of return, but a little riskier if instead of buying government bonds, you bought corporate bonds. If you bought the bonds of one company and that company goes belly up, you could lose your investment. You buy the bonds of 50 different companies, you're pretty damn safe. But again, assuming these are safe, stable, blue chip type companies, you're not going to be paid a lot because everyone knows these companies are pretty safe, and so you're not getting paid a lot because you're not taking on a lot of risk. And in general, you should understand that about investing. When you invest, you're being paid for two things. One, the use of your capital, and two, the assumption of risk. So the longer you tie up your capital and the more of it you tie up, the more you should expect to be paid. And also the more risk you're potentially taking, the more you should expect to be paid. Now, if you want to start to significantly increase your risks, you can do so and still keep it very safe as long as your time horizon is long enough. And the way you would do this is by essentially indexing the stock market. Now, as soon as you're putting your money into the market, yes, you're no longer guaranteed to not lose money. The markets absolutely can go down. If you look at any market index, S&P 500, NASDAQ, whatever, they do go down periodically. And so you could lose some of your money. However, and you can correct me if I'm wrong on this, I don't know of any 15-year period where the market overall lost money. Even if we talk about the worst moment of the Great Depression and the market collapse, you go 15 years later, you would be overall profitable. So as long as you have a long enough time horizon, as long as you're not investing with money you can't afford to lose, and as long as you can keep it there long enough for the value to be realized, you're going to be basically guaranteed to make money by investing in the market as well. And why is this? What's the actual mechanism by which you're making money in the market? Well, essentially, you're investing in human labor and human ingenuity. When you invest in a company, you're buying shares in the efforts of that company, which is the individual work and ideas and capital being employed by millions and millions of people. So there's real productive capacity, there's real value there, and that's what you're getting paid for. You are becoming a part of the business. And again, when you start investing in companies, if you invest in one company, it goes belly up, you could lose all of your investment. If you invest in enough companies, and importantly, enough companies that are different enough from each other, and so one failing won't cause other ones to fail like dominoes, then you should be relatively safe overall, and in the long run, you're basically guaranteed to make money. Again, I use guaranteed in quotes because there's no guarantee there, but statistically it would be insanely unlikely for you to actually lose money in the long run with that strategy. So now hopefully we've established that you can absolutely guarantee a return in the market by either buying incredibly safe assets like bonds or by buying stocks and holding them with a forever time horizon, which basically means that the statistical chance of you losing money over a long enough time horizon is essentially less than that of being struck by lightning, so we can essentially overlook it. So if it's very easy to make money, and if the markets in general do go up, how do people find ways to lose money? Well, people are very creative in terms of doing this, and let me show you various methods. Probably the most prevalent way that people lose money is by not following a simple strategy, by succumbing to fear and greed. See, a lot of people are most likely to get into the market when it feels the safest to them, which ironically is usually when it's the least safe. When everybody's piling into the market because it's performed so well and your taxi driver is giving you stock tips, that's when most people feel safe. Like the market goes up and up and up. It's a no risk. I can't lose. I have to get my money in. And what happens here is that people are most likely to put their money into the market during a speculative bubble when it's actually overpriced, overvalued, and most likely to go down. And so they are, by definition, buying high on average. To make matters worse, most people don't fully understand the investment, and when that investment starts losing money, they tend to get scared. Also, if they're following general consensus, they're following the herd, other people are getting scared, other people are talking negatively, and they think, oh wow, the market's scary now, I better get out. And what this means is they do the absolute opposite of buy low and sell high, which is what you should do. They buy high when there's a lot of people saying the markets can't lose and it's at a peak and at a bubble, and then they sell low when they're scared and terrified of losing everything. The best strategy for these kind of people would be to put their money in the market and then close their eyes for 10 years and pretend the market doesn't even exist, and then look back and see how they've done. This would in effect save them from their emotional fallacy and allow them to profitably participate in a winning game. The next way that most people turn the winning game of investing into the stock market into a losing one is by being under-diversified. See, what we were talking about before was buying the market in general, buying enough shares of enough companies so that if one company failed, you don't lose everything. But a lot of people go wrong by just buying one or just a few companies, or a few companies that are very similar to each other, so that when one loses, they all lose, and your investment can go down tremendously. If you're not a sophisticated investor and you don't have a strong understanding of what you're specifically investing in, you should be diversified. Basically, the less you know about what you're doing, the more you need to be diversified to protect yourself from risk. If you really, really know what you're doing, you can then get away with being less diversified, at least to a point. But you pretty much would never want to be so undiversified that if one single company goes down, you would be completely screwed. The next way that most people lose money in the markets is by forgetting that there is a simple winning game and thinking that they have a better idea. Again, if you buy a bit of everything and hold it forever, you're going to make money. It's just basically statistically impossible that you won't. But if you start doing fancy, tricky things that go against that fundamental reality, you're going to be in trouble. One particularly bad general strategy would be if you're trying to make money by shorting stocks, right? And shorting basically means selling something before you buy it, or essentially betting on the stock to go down. Well, if in general, on average, stocks go up, and you're betting on a stock to go down, you can win money sometimes. If you ever watched the movie The Big Short, for example, that's an example of a short that was very well justified, very well thought out, and made its investors a lot of money. But when you are shorting, you are fighting against human ingenuity, human labor, you're fighting against other people's success, and you're fighting against the winning game of buy and hold. So if you're gonna try and make money by selling short, you need to know what you're doing far more than you would by going long the market and just buying and holding. Another example of where people can get very tricky and get away from the simple winning game of buy and hold is when people start doing technical analysis and using charts, starting to think that because the stock's moved this much in this direction, now it's going to move this way, or that, you know, when it hits this like line of resistance, this other thing's going to happen. There may be patterns in charts. There may be ways to profit from doing this. But if you're doing this, you're in direct competition with other people who are playing the same game. And so you're relying on being better than them, being smarter than them, outthinking other people. So now you're playing essentially a zero-sum game instead of a positive-sum game. Let me define that very quickly. A positive-sum game is a game where, in general, people are making money or people are winning. A zero-sum game is a game where for every winner, there is a loser. If you're trying to make money on technical analysis, for every time you're right, someone else has to be wrong. And so in order to make money this way, you have to be the smartest person in the room. And there are a lot of people doing a lot of analysis trying to be smarter than you. So can you make money this way? Yes, you can, but it's much more difficult, and you're getting away from the simple winning game. You're trying to win by outsmarting people instead of trying to win by the inevitable force of a growing market. The other problem with a lot of these fancy strategies, which won't guarantee a loss, but will eat into your profits, is every single time you trade, you're being charged a fee for trading. So the more trades your strategy entails, the more you're skimming off the top of your profits with fees to brokerages or market makers or other people that facilitate trading. The next way that people turn a winning game into a losing game is with leverage. And what is leverage? Leverage basically just means buying more than you have the money to buy. There are various ways you can get leverage, like for example, through options, futures, etc. Typically, when you get leverage, number one, you're going to be paying a fee for getting leverage. So when you do leverage trades, it's possible to be right and still be wrong. So let's say you buy a call option. Basically, you're putting a bet on a stock to go up. But let's say you pay 10% of that stock's value in order to buy that option. Now, if the stock only goes up by 5%, even though you were right and the stock moved in the direction you thought it would, you still lost money because the price you paid for the option was greater than the amount of movement of the stock. So with leverage, you can make more money faster. However, you're decreasing the probability of making money on each individual trade because of the fees associated with doing so. The other problem with leverage is that for any particular asset or any particular trade, it's actually possible to inherently overbet. It's possible to take a good trade, bet too much on it, and turn it into a losing trade. Let me give you an example of this. Assume that I say we're going to bet on the outcome of a coin flip, and let's assume it's a fair coin. Every time the coin comes up as heads, I'm going to give you 80% of the amount invested. Every time it comes up as tails, you have to give me 50% of the amount invested. Now, that's clearly a profitable bet for you. That's clearly a bet you should take in some manner. But if you were to take that bet with 100% of your assets at any given time, over a long period of time, you're guaranteed to lose money. While you are making an 8-to-5 profitable ratio in every bet, if you were to lose half of your investment, i.e. lose one bet, and then win on the next one, you would only make back 80%. And when you lose half of your investment, you now need to win back 100% to come back to level. And it's kind of an interesting thing that happens, which is that money lost in investing costs you more effectively than money made because of the cost of recouping it. So for this reason, it's quite easy to overbet a winning strategy and turn it into a losing one. If you were to take this same strategy and bet it with 10% of your portfolio, you would be clearly winning. If you bet it with 100% of your portfolio, you're clearly losing. In the world of gambling, there's actually a formula for this idea. It's called the Kelly criterion, and it basically gives the amount that you should bet in order to maximize your return given a particular set of outcomes of a particular bet. And the same criteria can be applied to investing. If you end up betting significantly more than the Kelly amount on any particular proposition, and you do this over and over again, you're basically guaranteed to lose money rather than making it. So by over leveraging yourself, even if you could get free leverage, which is oftentimes hard to do, you can actually turn a winning proposition into a losing one. And a final way that a lot of people take a winning proposition and turn it into a losing one is they end up betting on things that are not actually assets, but are actually speculative. And I'm not going to go into too much detail on this particular point in this video because I want to make a whole video just on this topic. But essentially, for definition purposes, an asset is something that has a clear path to putting money back in your pocket. Speculation is something where in order for you to get money back in your pocket, in order for you to see a return, it requires someone else to be willing to buy something from you for more money later. There's not a clear path for you to recoup investment outside of the decisions of other people. And so people treat a lot of things that are essentially speculation as though they're investments. Things like, for example, baseball cards, in some circumstances, art, watches, certain cryptocurrencies. Certain cryptocurrencies could be investments, certain would be speculative. We can get into that more in that other video. But the point is there are certain things that are by their nature speculative and are not fundamentally investments. If you're putting your money into speculation, you're at risk at any point of losing all of your investments. And in the very sage words of Warren Buffett, a string of large numbers multiplied together with even 1 0 in the sequence always equals 0. You want to be very, very careful not to have investments, i.e. speculations, where your investments can go to 0 very easily. And again, I don't want to go into too much detail about that here because in a future video, I am going to go into much more depth about the difference between assets, liabilities, and speculation and how these play into an overall plan to how to become wealthy or how to get rich. So I'm going to leave that idea here for now, but hopefully you at least understand the idea that there's a difference between a true asset and something speculative. So here's my suggestion to you. Whenever you're about to invest in something, remind yourself there is a way to basically guarantee a profit. And whenever you deviate from that basic winning strategy, make sure you do it for a very good reason and with full information. You don't want to be investing by just guessing and hoping, and always keep in mind that money lost is hard to get back. If you lose 50%, you have to get back 100% just to get back to even. So the first rule of investing is don't lose money. And the second rule of investing is don't forget rule number 1. Thanks for watching. I hope you enjoyed this video and you enjoyed the introduction of new topical material for this channel. Take care, be smart, invest wisely, and I'll see you on the next one.